All right, let me bring up the moderator for the next panel. Kevin Winston will be here, and he'll talk a little. Come on up, Kevin. Big welcome to Kevin Winston, one of the people that'll be part of the next panel. Kevin, welcome.
Thank you. Thank you very much.
This is Flash Winston. Tell me a little bit about yourself in the audience.
All right, so I'm Kevin Winston. I run Digital LA. It's LA's largest tech networking group. We do events all the time around startups, tech entertainment. And we've done crowdfunding panels, Bitcoin panels, and I run something called Silicon Beach Fest, which is LA's largest startup tech conference.
A lot of fun, yeah.
It's a lot of fun, yeah. It's a lot of things going on, so yeah.
So tell me about the panel that's coming up. What are you going to be doing?
All right, so we have an awesome panel lined up of VCs who are going to talk about and give you guys the inside scoop on how to think like a VC. They've been backstage, and I've just been talking to them, and they have a lot of good advice. So we are looking forward to that.
Take it away, Kevin.
All right, sounds good.
Thanks very much.
All right, hey everybody in the audience, how y'all doing today? Can't quite hear that. How you guys doing today? How's your Crowd Invest Summit? All right, that's what we like to hear. Cool. So we're on day 2 of an amazing 2 days with the largest crowdfunding conference in the U.S. So super excited to moderate this next panel, which is all about how to think like a VC. We have some of the top VCs in the LA local area and in California who are going to impart some advice to you. So let's go ahead and get this started. We'll do with introductions. Again, I'm Kevin Winston, founder of Digital LA and Silicon Beach Fest. We do events all the time, thank you. And let's go ahead and get started from this side. All right, so do name, company, and then we'll just get into the questions.
All right, sounds good. I'm Ryan Azlein. I'm actually not technically a VC. I'm a VC and startup lawyer. I'm a shareholder at Stradling, Yoka, Carlson, and Ralph.
Hi, I'm TX Zhuo. I'm a general partner at Vickery Ventures. It's a $40 million LA-based seed fund.
Good morning. Rich Gupta with Rama Crowd Capital. We fund private and growth stage companies.
Dustin Rosen. I'm with Wonder Ventures here in LA. We focus on pre-seed, true early stage companies with about 20 million under management.
I'm Rob Vickery. I'm a GP of Stage Venture Partners. We are B2B and SaaS seed stage fund, $20 million size.
All right, that's our speakers. I want to figure out, as we go over the course of our discussion, who you are in the audience. Who here is currently running or has run a crowdfunding campaign for your idea, for your startup? All right, who is thinking about doing a crowdfunding campaign, and that's why you're here at this conference? All right, cool. Who here is also pursuing the VC route? All right, cool. Who here is pursuing either VC or crowdfunding, whoever will give them money? Okay, got it, all right. So let's go ahead and, all right, so since we have a lot of folks who are doing crowdfunding, and it sounds like some folks are thinking about VC, let's actually kick this off with the first question. We're at a crowdfunding conference. This is a VC panel. So the elephant in the room question, I think, for people could be, what's the role of VCs now in this world of crowdfunding, where you can basically, put up your idea on a site, get some money from the crowd? What is the role of VCs? And with people who are thinking about developing their startup, should they go for crowdfunding or VC or a blend?
I think the difference between the two is that, particularly with VCs these days, we are active investors and we get involved with our startups, from helping them with hiring to raising future rounds of financing, strategic development. So we're very hands-on. I think the big difference for crowdfunding is that I'm not sure if you get that much connection with your investors. If you have a dentist from Idaho who has put 10 grand into your electronic skateboard startup, I'm not sure whether that's the same connection you have as you would do with people like us. We are in regular engagement with our founders. So that to me is the difference.
Okay.
I have a pretty positive view on it. I've actually run a few AngelList syndicates in building out my fund, and I've been amazed actually where a small investor in a company I did called Arcadia Power, which is Washington D.C. based, not in a major hub, in clean tech. Found 3 or 4 individuals that have made real business development introductions for them, so positive. And to be honest, it was a company that couldn't raise traditional VC money at the time because they couldn't get to the big VCs, but that $500,000 of crowdfunding was the difference to get them to a revenue run rate where they just closed the $6 million Series A. And so, as VCs, we don't care where you got your previous money from that much, as long as you've built traction and there's something to invest in. And so, I'm a fan of anything that helps you move your business forward.
Great. So crowdfunding can help you get your business to a point where you have customers, you have a product, you've raised enough money to hire, employees and staff and developers and get something off the ground, and then you might be at a stage where you can actually look at VCs because you have something more built and you have customers. All right. Anybody else want to add to that?
Yeah, I can add to that. I think the choice is between venture fund or crowd fund or any alternative ways to raise capital. We find that folks should be looking at all combination of to get the capital at. Crowdfunding is definitely a new way of doing strategies and developing cash and developing more and more growth capital for yourself. And ventures have definitely, VCs have absolutely add tremendous value, and I believe they will be continuously add value. But new alternative technologies using either ICOs or using crowdfunding is a new way to go get growth capital as well.
Okay.
I think just word of advice for entrepreneurs in the audience. I think crowdfunding is obviously a good way to raise money, but oftentimes you don't form that one-to-one relationship with your investor. So what happens is that what you communicate might not be the complete story. And once they become investors, they raise a lot of questions. They don't understand the business fully. So I think spending time with a VC allows you to fully understand what the VC wants, and at the same time, we fully understand what your company is doing. So it's not that crowdfunding is a bad thing, but if you go into it, just make sure that you communicate well to your potential investors and make sure you're aligned on the vision for the company.
Cool. I think on that note, that's interesting because if you're looking to raise a further round of financing with VCs and with larger angel investors that you have a one-to-one relationship with, the chance of raising additional capital from those is greater than having to go back out and doing another public offering on crowdfunding. I just think it's different. It's entirely different ways of raising.
Did you have something to add?
Yeah, I was just going to add a couple things. One, to build on that, and your earlier comment is that a value that VCs can bring is actually getting you to a point where you can raise more money if you need to do that, which the people in the crowd are not necessarily going to be able to do. And then the other thing I would just add is that I think it depends on what your business is, on whether you're more well-suited to go talk to VCs or whether crowdfunding is a viable option for you. For example, these guys haven't had a chance to talk about specific investments that they look for in their funds, but some of them may focus on enterprise software, for example, which is not necessarily lends itself to crowdfunding. But if you have more of a consumer-facing business, that does. And the crowdfunding can help you not only raise money, but sort of validate that there's a market or help you build a community. For example, I work with a lot of video game clients. I have one that has raised a couple $1 million through various crowdfunding campaigns. And it's a way for them to build their actual community of people who are going to play the game. So,
cool. All right, so nice segue into the next question, which is about what you all currently work in, what your basic areas of interest are as far as investments and expertise and sectors. So let's go ahead and kick that off. Just go ahead and let me know your top 2 or 3 investments. If you want to shout out specific names of companies, that's cool, or you can do sectors.
Well, all of our portfolio companies are awesome, so they're all in the top 3. So I won't give any individual names, but we focus on enterprise software and SaaS, and within that we like machine learning, autonomous vehicles, drones, deep learning, neural networks, computer vision, stuff like that. Stuff which you generally don't find on crowdfunding platforms, unfortunately. So yeah, that's what we're looking for. Before we got into VC, we were angel investors, and we had a pretty good track record of that, so that's why we kind of focused and moved into raising our own fund. But that's our particular focus.
Okay.
Wonder Ventures really focuses on LA and true early stage founders, kind of a new class called pre-seed that might be a little earlier than the traction you're often being asked for in your business. We call it micro traction. So instead of having $100,000 a month in revenue, you might have $5,000 a month in revenue. We really are looking for those big industries with deeply passionate founders, often outside of a lot of what LA invests in, so less in media and content, more in disrupting old industries. And some of the investments we've done at that stage include a company like Clutter here in LA that is in the on-demand self-storage space, has now raised $100 million since we were one of the first checks in the business when they had $1,000 a month in revenue. And so it's really about understanding those founders and those businesses and making a couple bets a year when it's too early from a traction perspective for other investors.
Yeah, who here has a lot of mess in their garage? Back rats, hoarders, yes. So Clutter is a Culver City-based company which will basically send a team out to your garage, take everything out, put pictures of it online so you can see it. If you want some stuff, you just say, hey, I want it, and they'll bring it to you.
Usually for less than the price of public storage.
So anyway, shout out to a local LA company. Yes.
Yeah, we like to get involved more at the later stage, at the growth stage companies, where we are looking for them to at least have a revenue in the range of 1 to 2x of our investment. For example, if you're looking to raise $3 million, they should have between $3 to $6 million of revenue, and we do pay attention to their bottom line and want to see where the growth capital is going to. We are indifferent whether they're making money or not, but we do care how the money is being spent. In addition to that, most of our investors are mostly accredited investors, and where we are focused on is mostly technology, biotech, and biomed areas, and specifically on anything to do with something new. Like we got involved with alternative battery technology. They have a revolutionary battery technology coming on the platform, and you all will hear it sooner than later. It can charge your phone, which you can charge for less than a minute. You can get up to 2 hours of call time. I will not give the name out, but you will hear it soon. And we also got involved with a company who does specialist-based telemedicine help for rural America. So that's also a pretty creative investment strategy we take. And majority of our investors are accredited, so I do take exception to that crowdfunding guys don't have advisories. They do. Our investors do advise us to how the companies can grow, and they may also interact with the companies through us or directly after becoming investor. So we do partner up that way.
Cool.
So we're a pretty traditional seed fund. We focus on companies that have a product in market and have some form of traction, whether it's a couple of beta customers, whether it's some revenue. The three big sectors for us are enterprise software, financial services, and marketplaces. Our current fund is pretty new, but in our prior funds, we've invested in companies like Robinhood, Policy Genius, Laurel and Wolf, Flexport, to name a couple. I think a guiding principle that we have is that we believe data will be your only defensible moat over time. So we like to focus on companies that are using data in an intelligent way.
So again, as my day job, I'm a lawyer, a corporate transactional lawyer focused on working with emerging companies and venture firms. So emerging companies is anywhere from brand new startups to later stage venture-backed companies. And like mostly in the tech space, but really it's agnostic, and like to work with companies all the way through their lifespan. So from when they're starting to when they're exiting. And then, you know, sort of on the angel investor side, it's the same kind of thing these guys are looking at. It's mostly local companies, a lot of companies we work with, mostly in the tech space.
Cool. All right, so hopefully you're taking notes if you're looking for investment for these guys in particular, because they just showed you there what they like. Cool. So let's dig into a little bit more as far as the main topic and title of this panel, which is how to think like a VC and how you guys spot startup investments. So given the various sectors you all said you're interested in and the stages of the company that you're interested in, how do you find these startups? Do you go to events like this, South by Southwest, tech events? Do you scour LinkedIn or AngelList or other industry directories or places to post things? Do you look at crowdfunding platforms and see what's going on there? What's bubbling to the top? Is it referrals from friends, referrals from VCs, or do you stick with like a couple people who've had successes, whether it's a VC or a startup CEO, and just do whatever they're doing?
I think the short answer is there's not one guaranteed good spot for deal flow. I think.
What are your top two?
I suppose we have great referrals from law firms. Generally, if someone is out there looking to register a business and wanting to build a new product, they need a lawyer to do that. So we find wonderful referrals from there. We also find that our founders, we've invested in publicly announced 9 deals from our funds. We've actually done 10, so we've got a lot of founders in that portfolio, and they are conversing and mixing with other entrepreneurs that are doing good things, and we trust our founders more than anybody else. So we find great referrals coming in from them.
Okay, so business referrals and founders and founder referrals.
Yeah, and then we will go to Y Combinator and 500 and all the incubators. Haven't seen anything on crowdfunding in particular. But yeah, most of our deals we've been mostly the first VC fund in some of them. So I don't know. There's no real secret sauce to any of it. It's just be out there.
How does someone break into that world if they are not part of the world of, business referrals or part of the founder club that you already
How'd you get
reached out
to our fund if you were not in that? follow us, like read about what we like. My co-founder and I are pretty active on Twitter and social media. You'll see the stuff that we hate and the stuff that we like and the stuff that we take the piss out of. So like, learn about what gets us excited and then approach us. We have a form on our website that you can submit to. We're not, totally unapproachable, but, probably don't come to us with a VR game, but come to us with something in a different space that we'll have a look at that. But learn a bit about who we are. Try not to do cold LinkedIn submissions. That doesn't really work. Just research us.
Cool. He said follow on Twitter. It's at Vickery Rob. By the way, I actually tweeted everyone's Twitter from at Kevin Winston, a backstage photo of us back there. So if you want any one of our Twitters, you can just go to at Kevin Winston and then follow everybody in the photo. All right, cool. Who wants to? Let's actually switch over to this side and then go this way. So how do you find these startups? You said you do a lot of startups. Is it like stuff coming from your legal work? Hey, we're doing legal work for this startup. This seems pretty cool. Maybe we want to throw some venture money out of it.
Yeah. Yes, I would sort of reiterate what Rob said, which is the best quality is going to come from referrals from someone you trust or trust their opinion. And oftentimes that's either from other investors or other founders or companies we're working with. We obviously have a lot of insight into. But we're also obviously out in the community and meeting people all the time and going to events. So that sometimes works out as well.
I think we've been tracking the source for every deal. I think the three big buckets. Number one, successful tech entrepreneurs. I think especially if they come from our prior portfolio, they can sort of attest to how we work with founders. So that's usually a very good referral source. The second is like great fellow VCs. I think Dustin has sent us a couple of deals, anywhere from the pre-seed guys to the later stage guys who might find, hey, deals are just too early for us, but we love what the founders are working on. And the third source, we've started to track sort of very promising talent within larger companies. So we're talking about manager, director, VP level, who might start a company in 2 to 3 years. So we foster a relationship with them with the hope that when they start a company, we'll be the first phone call. And then I think just want to touch on a question that that Kevin had early on about sort of how do you actually approach VCs. I think the card on, hey, you need to get a warm introduction has been overplayed. So I've been thinking about this question a lot over the last couple of months. I think we as VCs are drawn to people who have a unique perspective on things. So I think a very interesting way I've been thinking about it too, of how you can do that is create an online persona, have a unique perspective on either what you're building on a certain topic. And if you get a following that way, I think VCs will start to notice you. And I think we actually will be the ones who will proactively reach out and find out more about what you're building.
Cool. So develop a voice or some sort of expertise or something so that you're known for something, and then VCs might go after you. Okay. How do you find your startups? I guess it's not startups. How do you find your growth companies? So that's a little bit different from a lot of the other folks. You're looking for growth companies that have some stuff going on at a larger level. How do you find those?
It's all of the above. I think you heard talk about professional advisors, lawyers, or CPAs. We have 3 partners. We all have been around for longest of time. We all have some great experience in Wall Street as well as in a growth stage community and in our investor base. I mean, our sources of referral have been pretty much either our investors or the people we are dealing with directly. They may refer us something. Our challenge is that we do focus only on growth stage, but most of the folks come to us at earlier than where we like to. And that's the challenge for us to sort it out. And we do a very good job in sorting it out and referring it to others who we know are doing what we don't do. And hopefully we'll partner up down the road with them. So we build a relationship both ways. We refer out and refer in. To answer the question, there is no one secret sauce. Yes, people follow us on LinkedIn, on Twitter, and people find us. I mean, we don't have any hidden behind the wall approach. We are wide open. We meet conventions like this. We do all panels and discussions, and we share knowledge.
Okay.
I'm going to agree with everyone here, so why don't we do the next question?
Okay, great.
I think, Kevin, one thing important to talk about is also the relationship that the professional advisor, whether it's a CPA, whether it's a lawyer, has with the investor. I think oftentimes, and Ryan definitely doesn't fall in that category, but there are a lot of professional service providers who will come to you and say that, hey, work with us and I can make these 10 introductions to these VCs. But a lot of times they don't actually have a relationship with 9 out of 10 of those VCs. And when I get email for them, it actually annoys me, being honest with you, because I don't know who these people are. So I think as entrepreneurs, that's actually detrimental to your fundraise. So you want to make sure and at least call a couple of entrepreneurs who have worked with this service provider, say that, hey, does this guy or girl actually have the relationships that he or she says she does? So I think that's very important.
In fact, that's a good point, because we have a policy, we want to double opt-in when it comes to introductions. Like, I don't like a CPA just doing a cold email introduction to us, to a founder, and then we have to spend 10 minutes saying no to that person in a polite way so we're not insulting someone. So like, always try and like double opt-in. Like, if you are a service provider and you want to send startups to investors, just like ask us first and send us the pitch deck, and then we'll look at it and then let you know whether we want that introduction or not. Makes you look better, saves us a lot of time, it just smooths things out. Double opt-in. Yeah.
All right, so referrals, everyone unanimously basically said is the way to go. And to get in there, people could submit, I guess, a deck through your website or connect through founder who's part of the club, I guess, part of the insider group. When you're looking at a deck that comes through cold or an email or someone just sending it to you, like what are you looking for in this deck? And does it start with a deck? Does it start with a deck or does it start with a person who
I can
has a
answer
deck?
that. If it's cold call, if it only comes with a deck, chances are I will not even open it. And I will think this is somebody spamming me. So if they have not found ways to communicate through email, phone calls, or found us through referral source, chances are if they just send the deck in, that's not getting opened. So what we look for, obviously, if they have gone through a process, have gone through finding us, having a dialogue. I mean, I would suggest to every entrepreneur, do not send your material out without making some contact with either VC or crowdfunding guys like us, and then send the deck out. And what we look for is what's the strategy, how they're improving it, what's their execution plan, and what is their growth strategy. We really drill down on a growth strategy side and how the capital will be utilized.
Yeah, I think that's a good strategy in general in business, because I actually rarely open things with attachments anyway. So whether it's someone's resume or a deck, like I think I need to want to open the deck first. So tell me about someone or a company first, and then, oh, that's interesting. Let me see the deck. Let me see what they've worked on. Let me see the resume.
Exactly.
Anybody else want to add to that?
I would just say I think we all know it's an uphill climb on cold outreach, and I would agree if you can get it into a paragraph or 3 sentences, try and communicate something of a perspective to TX that make me want to engage, that's your best chance. I would put a lot more energy into finding those intermediary connections and references and referrals. The one thing I'd say more generally in terms of capturing that initial engagement is either that really diverse and different perspective, which I think everyone would probably believe that their business has. So therefore, trajectory, meaning talk about something, hey, I did this 3 months ago, and now it's tripled in 2 months, and now it's quadrupled again in 2 months later. Show some momentum across your 3 sentences to give me something to latch onto versus here's my idea. I have nothing in those 3 sentences to understand that you've actually created some momentum across that idea versus just telling me what the idea is, because we all know this business is 90% execution, 10% ideas, and so everyone just telling me ideas doesn't give me anything else to latch on to potentially get you through that kind of wall of engagement.
I think when we're looking at a deck, there's like 3 questions we try and knock out as fast as possible, whether this is something we're interested in, and we look for, like, why are you? So why are you the credible founder? Why are you one of the only few people on this planet that can actually build this product? We look for why now, so why can your technology be built right now? That's often reflected in the sophistication of the tech stack that you're working with, or just the fact that no one's done it before. We've invested in companies that are extremely sophisticated machine learning platforms, and we've invested in companies that are replacing paper and pen. So that can be, the why now question can be reflected in 2 ways. And then the third kind of piece we look for is like, why us? So why, ultimately, I suppose us as a business trying to market ourselves is that we always want to be the best investor on the cap table for you. So why are we the best investors for you? Can we help? Do we have experience in this space? Can we add value? So those are the three things we look for, and if we don't see that in a deck straight away, we tend to kind of move on. Another thing that really bothers us, a data point that we track a lot, is that when there are deals that aren't done or that have been done that we haven't seen, we spend a lot of time working out why we didn't see it. So that's converse to the question you're asking about. We get really pissed off when we see deals that...
So what's the answer? Why did you miss some of these?
We will find out who the lawyer is, and we'll contact them and say, hey, when you've got another deal, maybe send it to us. So yeah, we'll try and work it out. But that's so while we don't always want to see all these cold decks, we also get annoyed when we don't see them. So it's like, what do you do?
Yeah. All right. When you said the question of why me, or why that entrepreneur, and then tying with your question of what does the entrepreneur have to offer, what's their voice, there's a theme going on here, which is like, what is the entrepreneur, what does the startup have to offer? Like, what is your voice? Why is it uniquely you? What's your story? Tying into what Marcus just said on the previous discussion. What's your story? Why are you doing this? All right, so great discussion. I'd like to break midway through and do questions from the audience. Who here has questions on what we've talked about so far, or anything else? I like to do Oprah style, so I'm going to go into the audience. Okay, so we have Jonathan, who is co-founder of Ether2.
Yeah, hi everyone. Thanks so much, Kevin, for doing this. Our problem is a real sob story because at the end of our Google Research Award, it turned out that 2 Chinese OEMs could decide who they give open on-hub routers to. And I had engineers at USC, grad students, ready to be mentored from engineers who were IEEE award-winning in our technology. So Google Research Award. So the question is, our VC think experience has always been that the VCs are thinking, we're looking for something disruptive, and when it drops in their lap, it's not in their focus area. So the question is, how do we get around that hurdle, and how do we get you to understand that we're talking about creating a new kind of public utility with a new switch architecture that doesn't have the problems of old internet networks?
Okay, did someone catch that?
I caught enough to know,
Okay.
for example, that I would not invest in that business. And so I would advise you not to waste time if a VC makes it clear that they don't do infrastructure, wireless, OEM, hardware type plays. I'm purely software, and I'm sure you could try and argue with me, but we see hundreds of deals a year. We have to have a quick switch sometimes, and so I don't want to waste your time any more than you want to spend time walking up a hill with me that you're not going to get to the top of. So it's not a good answer, but I really do respect. I was a founder before I started this fund. I respect people's time. I've pitched hundreds of VCs and been told 99% no 99% of the time, and so my biggest advice often to founders is if you get that quick, this person's not interested, move on, and figure out other ways and spend your hustle trying to sell a deal, trying to get some revenue, trying to get some traction.
And to Rob's point earlier, that I think we are trying to sell our value, right? So for a lot of us, if we don't have expertise in that space, it's very hard for us to invest, because what we're selling to a company is that if you work with us, we can help accelerate your growth. So it's not a function that you don't have a promising business. It just doesn't fit well with sort of our backgrounds or what we focus on.
All right, question over here from Margot.
Hi, I'm on the advisory board of Silicon Beach Talent, and my question is, what is the biggest mistake that you see founders make when hiring their first team members that negatively impacts their ability to get funding?
Great question.
That's a phenomenal question. I tell you, when we look at majority of time we spent on the team as to what quality of team is it just their friends they grew up with, or they work together, and those things are not bad, they could be great, but the question is, how are they adding value to the organization they're pitching us? So it's critical to find right talent, not right chemistry, and chemistry is very, very good as well, because everything is based on, especially when you're an entrepreneur, is based on your team, how you work together, how you move together, how everybody's adding value. So what are the qualities you're looking for is, what is the strategy? How is that strategy being implemented by all of the team members? Are they rowing together? Are they rowing against each other? Those are the key elements we look to see. And the team also has to be very rigorously involved with their background, with their education, with their expertise. And those are the elements, I mean, we can sit here and talk about through the interview process, but that's what we're looking for entrepreneurs to guide us as to why they selected a team member and how they're adding value to it.
I think from our end, hiring is the most important and the most difficult part of a seed stage company is finding the COO that you need or the CTO. You know, we actively interview a lot of candidates for our startups. We come in as like the evil interviewer at the end and like kick their ass a little bit. What we're looking for is people that can embrace optionality. So people who, in a small team of 7 or 8 people, you need to be able to shift skills into marketing or into biz dev or into hiring people or firing people or dealing with insurance policies that you don't have, things like that. So we look for people who are able to adapt, and particularly people from corporate worlds like I used to be from. You know, you get institutionalized and you're not so good at that. You're good at one track. So we like people who are able to expand.
I would give the cynical answer that as a former founder and as I think about success of the company, I agree, adaptive, smart, hungry, hustle, talent over specific job function, institutionalized corporate knowledge. But I will say as a VC, if you say, hey, our head of tech came from XY other successful company in LA, it helps your deck. You could put that Snapchat logo on your pitch deck, and it really makes a difference. So as much as I like to sell other things, especially when it comes to the people within your organization that do a specific job function that the VC is more specific, so technical, growth marketing, those logos do matter and they help get your deck noticed.
I think one quick thing to add is that just make sure the hire is stage appropriate. So a lot of times you go for a big name CTO who hasn't coded for the last 15 years, but I think what you need at an early stage startup is someone who actually can roll up his or her sleeves and actually do the work. And a lot of times you overhire for that position with understanding that over time sort of needs might change and you might have to hire someone on top of that person. But I think for what you need at the early stages is you want to find someone who can actually operate and execute.
We have a question from Anthony with EVIP Entertainment.
Hi, I have a question with regards to investment opportunities. Because I've met a lot of VCs and angel investors, but they kind of try to shy away from media and entertainment. So I'm just very curious, why is that?
Well, I previously founded a company. It was a mobile application in the shopping fashion space, and we ended up kind of unintentionally pivoting into the media entertainment space, and we had a million uniques a month. We had 10 million downloads, but most of our revenue was coming in through ad-supported, which is traditional in the media world. We're doing about $2 million a year in media. I was getting introductions to the CEOs of Condé Nast and Hearst and major media companies, and they would come in. They say, we love this. We think this is our future. We want to buy you. And they say, we'll pay you what our multiple is, 3x revenue. Okay, that's a $6 million valuation. Oh no, I had raised $7 million in venture capital for that company. You got to look at the exits as the entry is important. And so a lot of media companies, if you look at the publicly traded media companies, are trading at 2, 3, maybe high growth multiples on revenue, especially if it's ad supported. And so when we're investing as a VC and we're looking at our money coming in at a similar valuation and we know the projected outcome, it's really hard to line those up. And so, it's a reality of the nature of the business, where the revenue comes from and the exit multiples that the companies are coming out on, which I felt firsthand in a not great way.
I agree with you completely. I mean, I used to work in a little bit in the content industry, and multiples are not there. Like SaaS multiples are kind of 10 times annual recurring revenue, which is quite easy to compute and to get pretty significant exit out of. The other issue with like content is that it's very hit driven, and being able to repeat the success of a popular video game title that you might have created, or a popular film that launched at a certain time when the stars are in alignment and chaos theory was in your favor, is not repeatable. I don't find it to be a particularly scalable business. But
what about a content platform, like a distribution platform?
Well, let me take a quick step back though. That doesn't mean it's bad business. It means that VCs that think like we do are misaligned for what you want. Had I built my business slow and steady, and I could have easily done that $2 to $3 million a year in revenue with $1 million of cost and generated $1 million in EBITDA, I could be putting that EBITDA in my pocket every year and had a great business versus my venture capital was misaligned with a nice $6 million company I had built. And so, taking VC money is because VCs are good at selling you money. If you think about what VCs do, we're in the business. It's totally changed my thinking, and it's maybe something I shouldn't say publicly, but VCs are in the business of selling you money for part of your company. And you don't want to necessarily get sold on my money if it's not the right alignment for your company, especially for the potential outcomes that that are most realistic in your future.
Right, so do your research, make sure that your VC actually has some entertainment investments or has come from that world so they understand it. We have a question over here from Anthony with Trelp.
It's Andre from Trelp. Trelp is a crowdsourcing platform for truck drivers, basically crowdsourcing last mile directions and untraditional parking spots, and where you're also able to review shippers and receivers, which is a huge issue.
What's your question?
Okay, my question is, if you guys are interested in investing, then reach out to me, please. And then the second question is, what are the 3 most annoying ways to approach a VC? Which I hope this is not one of them.
Could have been one of them. Okay. All right, thanks. Andre.
Pitching them when you're supposed to ask a question. No, I'm kidding. I'm kidding. I'm kidding. I think as they alluded to, one is sort of cold emails without any context. So if you reach out, at least I think it's easier to go through a trusted source. I think it's just very hard for us to make head or tails of a business pitch if we have no context. I think the second thing is overselling. Like, hey, we'll become the next billion-dollar company, and if you don't jump on this train, you're going to lose out. So I mean, that's fine. I think I'm happy to wait. And I think that the third thing too is sort of not demonstrating a willingness to learn or willingness to be open-minded about what you're building. I think a lot of times we ask questions not to push back, but because we're interested in learning more, and we find entrepreneurs become very defensive. We are the best company in town. There can't be a second company doing this. There obviously can be. So we love to have a very open conversation where you're receptive to feedback. So I said, those are the 3 things for me.
Cool. We have a question from Matthew with Zen.
Hi. So I think it's this year that ICOs are outpacing early stage venture in investing in early stage companies. So I don't think I've personally heard from any VCs yet what their thoughts are about this, and if there's some fear there in terms of deal sourcing and FOMO, basically.
Not really from us. We don't. I think it's great. There's another funding source for startups.
Thanks.
I just don't see SaaS and enterprise software and B2B software being particularly suitable for ICOs. So no, I don't have any fear at all. I welcome it.
I mean, I'm not a lawyer, but I can tell you ICOs are the new technology folks are using to raise capital. My advice would be just make sure, get a good lawyer, and don't do anything which a lawyer tells you not to do.
All right, we have a question from Key Trang with Forbes.
Hi, I have a lot of, I cover Shark Tank for Forbes, and a lot of people come to me and say, oh, can you connect me with this person? And they want to say they work so hard, and they always have a story about how they overcame cancer or some type of other personal ailment. I was wondering what you think about pitches like that, and what if you think that makes the person stronger, or is it just another gimmick, or what?
I think if it's additive to the story, it has to make sense, right? So I think if I mean, I hate to bring up this example, but I think if you have a family member who has had cancer and you want to focus on a company that is trying to solve the problem or increase sort of information sharing, then I think that's a pretty noble cause, and I can see where your passion comes from. But if you tell me that, hey, you're doing that, and now I'm building, I hate to use this example, a trucking company, then I think I don't see the correlation there. So I wouldn't see it as a positive or negative. It's more of a neutral sort of experience that you had in the context of obviously fundraising.
I would just add that you obviously have to then back it up with a reason. So I want to build a cancer company. Have I spent 10 years in the biotech field? Did I find 2 co-founders that have worked in oncology their whole life? And so the story can help grab someone's attention, but you obviously have to back it up with the depth of knowledge to be able to build the business as a result.
Try and like under-promise and over-deliver. We had a startup come to us claiming that esports increases your graduation rate by 80% from university. That's not true. It's probably the other way around. So just be able to back it up and prove it. And if you're making medical claims, I mean, that's a bold statement to make, and that's not a bet that I would like to make if I was a founder. So under-promise.
So make sure the story is part of the story. Question from Amy with products to profits.
I'd like to know where you send deals that are too early for you. What do you do? Where do you send them as a resource?
I think I talked about that earlier. Since we only focus on growth stage, so if the folks are coming in, they are at very early or at a design phase or early seed round, we try to find a home for them. We never tell them go away. So we're very respectful of their time, and they're very respectful of our time, especially the trucking guy. Good pitch. So no, I mean, this is just a referral source at that point. We just pass it on to the next level, and we'll recommend them name or two so they can go pitch it to.
Cool. Next question. Diversity and people of color, veterans, disabled, having startups and those startup founders with these backgrounds is of course of key importance. What are you guys doing to make sure that you are investing in a diverse portfolio?
Well, my co-founder is a minority, and all of our portfolio, I think throughout all of our portfolios, we've got veterans from the military, from the police. We've got women founders. We've got I think we hit most of the major ethnicities. Do we go out and kind of search for people based upon that? No, I think we're looking for great founders. We welcome people who come from a diverse background, but I don't think we filter by that way.
Okay.
Yeah, I second that. I mean, look, we don't look for any particular race, religion, creed, or whatever. We just look for great founders, great team, and see how they can multiply the returns we're looking to get. And we've contracted and talked to every kind of people we can possibly think of.
Okay.
It's a problem. I'm not going to sit here and claim it's not, and certainly as a white male, I am part of the majority, too much of a majority. I think it starts with hiring in our own field. So, I'm fortunate enough now to be looking at hiring my first person in the fund, and I'd love to see resumes from all different walks of life. It'll be a junior analyst, 1 to 2 years out of college. So if anyone has any great LA-based hustlers to fit that, I'd love to see all sorts of resumes and try and, look at all types of people in my hiring, at least to start there.
Cool. Anybody else want to add to that?
I guess I would just add to that if you are in one of those minority categories, there are resources out there, and there are investors that focus probably on your category. So try to take advantage of that as much as you can, and leverage those resources to try and help you build, because it can be a challenge at times.
Cool.
I mean, I agree with you. There should be a woman up here on this panel, or so a little bit more diversity. Sorry to see that there isn't, and our industry has been rocked by some fairly bad behaviour from some of our peers, and don't welcome that at all. So I'd love to see more diversity in this industry, because it desperately needs it.
Okay, great. Last question is, let's say that, an investor had, a startup had an idea for a time machine, whether it's a DeLorean or a phone booth or whatever, and you can go back in time and tell your earlier self some advice on how to be a better VC. What would your advice to your younger self be on how to be a better VC, based on what you've known with all your experience now?
Can I share a quick story? And that's actually someone who pitched me on a time machine. It was a time machine / teleportation device. So it's like, so my response, it was a cold call. So I said, hey, if you can teleport here right now in the next 15 seconds, I'll give you $1 million.
Nice.
That's all I had.
Good one. Any of us want to answer that? We should just drop the mic and end right there. But what advice would you give to your younger self as far as how to be a better VC?
I would say ownership. Everyone talks about, well, I invest in 30, 50 companies, and one of them becomes Uber, and I'm great. Well, there's one Uber a decade, and there's a 500 plus professional VCs and growing quickly. You can make good money as an investor if you own 10, 20% of companies that do pretty well and do very well, excuse me. Building a $50 million company is an amazing thing to achieve. And so as I see the ownership get decreased every dilutive round, I realize that I really want to own more of companies and be able to help more, but actually invest in less companies as a result.
Allow for more time. I mean, a lot of you are looking at raising money for your startup, but we have to raise money for our venture fund, and I can tell you that's not an easy thing to do. Whether you're dealing with family offices or institutional LPs or high net worth individuals, always allow for like an extra 12 months. It took us a long time to raise 2 venture funds, not going to lie to you. So what I would have gone back to myself and said, like, be a bit more patient.
I agree with that. I think if I can talk about myself, patience. We were very quick in early days of not really paying attention to what was pitched, and we learned and we improved that. Now we really pay attention to what's being talked to, how we approach ourselves, and be a little bit more respectful to individual time with the people who are pitching us, because they have gone through hurdles as well. So that patience, I think, goes a long way.
Interesting.
So I think beyond the story about the time machine, I think I think
very good story.
The biggest learning for me, it's still very hard to tell between the good and the great companies, but the no's are very easy these days. So I think we spend too much time on the no's. I think a big learning in the early days for me, if I could actually cut down the amount of time I spend to get to those great deals, I think I would have been able to cover a lot more ground. So we're trying to do that actively, but if I had to turn back the clock, I think that was something I would change.
Okay.
I guess I would just add, based on sort of lessons learned and seeing companies succeed and fail, of how much of it depends on the founders and their team's ability to execute, as opposed to sort of this sounds like the next greatest idea or it's a huge, gigantic market. So trying to figure out the ability that they'll have to execute on their plan or change their plan and execute on the new plan.
Awesome. Well, thank you so much for a great discussion, great insights. Let's give it up for our panelists. Thank you so much.
Thank you.
Thank you, Kevin.
And thanks also to our organizers today. Thanks to where's Alon? He's I think backstage to carry it on. Thank you for so much.